have with me Mr. Sridhar Chityala, the chairman and principal of EIP and the Vedas Group. Vedas Group is a single family office based in Singapore. Mr. Sridhar, thank you so much for joining.
It's a pleasure.
Mr. Sridhar, we are today talking about the megatrends shaping family office and investment landscape. My first question would be, and we all know that there has been a lot happening in world right now. And family offices are known to have a 60-40 or 70-30 portfolio in terms of liquid and illiquid assets. But with these headlines coming in, we also know that portfolios can be wiped out in a matter of few days. We've seen that happening in 2025 a couple of times. So where does the 60 balance lie? How do we look at the portfolio allocation in this current environment?
I think these are great questions. First and foremost, I think one major trend that you are witnessing is, doesn't matter whether it is a single multifamily office or whether it is traditional investment institutional structures that are prevalent, but now more and more people are combining both public and private markets into a holistic kind of a portfolio, recognizing that at the end of the day, both of them are expected to derive certain valuations and outcomes from an investment returns point of view. So under those circumstances, in a climate of high volatility and constant changes, you need to have an element of flexibility, which gives you the opportunity to be liquid, but at the same time flexible to allocate in opportunities that arise as a result of these changes. So if we take the traditional, forget the private markets, historically it used to be 60-40 people will sit back, rebalance maybe once every 2 years or once 18 months. But today we are no longer in that environment of sitting static and expecting what comes out of your allocations. So more and more institutions are recommending, and which we follow as well, is more 80-20 or 90-10 with high amount of allocation to equities. Because equities are liquid. Fixed income, if you take a look at the last 3 to 4 years, it has remained a very high interest rate linked to the 10-year treasuries. The rates have not bungled. We have seen one rate cut, but other than that, in the last 2 to 3 years, we have not seen rate reduction. And also, if you take a look at the last 5 years, there has been a shift in terms of allocations. If you take the top 20 globally, the assets which have grown, within the equity portfolio, have remained fairly static. If you take S&P 500, almost 85% of the companies have not generated more than 4 to 6% yield, and most of the yield and the growth has come from these top 15, 20 companies. So to achieve this flexibility, recognizing the public markets have also, because of high interest rates and low mobility and availability of capital, you need to be in a more flexible liquid structure.
That's very interesting, because a lot of reports that we read these days, they talk about the growth that private markets are seeing, right? And if we go back to the family office space, family offices are beginning to play a bigger role in the private market space. So then is this a little bit of a contra to the trend? So do you think like a massive reallocation is due, or are these numbers just being projected, are inflated?
Well, I think we live in a world what we call as dynamic allocation. We also live in a world where remaining static and remaining not cognizant of what's happening in the markets is no longer the trend, which is why we even have published certain papers to say that family offices must have their own in-house research so that they can constantly have, besides external input, internal input in terms of the changes kind of taking place in the market. Pre-COVID, which is 2019, 2020, traditional allocations model, both in public and private markets, sort of worked. And one could generate extraordinary outcomes from the private markets. But today, post-COVID, many of the companies have not only perished because of debt and because of shifting landscape, public markets have outperformed the private markets besides having liquidity. Therefore, the trends that you are seeing and reading about emanating from United States or emanating from even parts of Europe is a reflective of these changes. It will take some time for Asian markets. So that's why people remaining flexible and with a higher allocation to high growth equities gives them the opportunity to exit even in the event of market going downward.
One more thing, I mean, we talked about mega trends and the way dynamic allocation is needed. So, of course, we all know the mega trend of Trump-led volatility.
Yeah.
But besides that, if we keep that one aside, what would be the other mega trends that you see which will shape asset allocation in the coming couple of years?
Now, what are the trends that we are seeing most noticeably in the last 6 to 12 months or so, leading away into the Trump era, right? Is rare earths is one of the top areas, and everybody is trying to move in because they clearly see that as much needed what shall I say, commodity, and the world itself is fighting for kind of rare earths, which is going to power a number of things. So that's one. The second that everybody now accepts is AI. Okay, AI, the world of AI, which whether it is chips, whether it is AI data centers, whether AI platforms. Just in the last 1 week, Trump granting permission to NVIDIA and AMD to export to China, and in the process allocate profits to the United States, you saw immediately uptick in those two. So if you're not dynamic and if you're not allocated, then at least you can exit somewhere, even if it is you are entering at a high price. And the third, I would say, is the whole EV and EV chips. You can see TSMC from Taiwan now setting up factories both in US, and the growth of semiconductor in India, for example, the huge semiconductor complexes that you have in China and Japan, reigniting that market is another big trend. I think the fourth is power. People have underestimated all these technologies required huge amount of power. So you are now beginning to see that even Google has invested, few $1 billion to make sure that they have power-enabled infrastructure to drive their own platforms. So these are some of the trends, and you need to be nimble and flexible enough to allocate.
So I believe volatility is the key, and remaining nimble is the key, and dynamic asset allocation is a key for asset allocators in the coming period.
Exactly. The Trump era is going to be month to month, day to day, week to week surprise. So those who are significant amount of capital allocated in the market needs to be nimble, recognizing what he is saying and what he is not saying. And also geopolitical wars that are going on, which we should not underestimate. We have Russia-Ukraine war, we have the Gaza, Israel, the turbulence around Iran, the India-China situation. Well, again, India-China situation, you can see now they're trying to resume a fair amount of activity. Now, that in itself is a huge opportunity, because we are talking about two countries between them probably represent 50% of the world's population.
Thank you so much, Mr. Sridhar. And for all of you, Mr. Sridhar talked about in-house research. The Vedas Family Office has its own research, publish it regularly on the LinkedIn page. So do look at what the Family Office and the funds are talking about.